69.6%. That is the absolutely staggering return a group of 7th graders, 12-year-olds, achieved over just a 2-year period. And to put that into perspective, they completely crushed the S&P 500's 26% gain during that exact same time frame.
So, how exactly did a bunch of kids who aren't even old enough to drive outsmart Wall Street's highest-paid professionals? It sounds like some crazy David versus Goliath mystery, right? But the truth is, they exploited a massive advantage that, believe it or not, you already possess. If you stick with me to the very end of this explainer, you're going to master 3 massive secrets: the crayon rule, why professional money managers are literally structurally designed to lose, and how to bulletproof your mindset against terrifying market crashes.
Welcome to The Explainer. I'm your host, and today we are tearing into the legendary financial blueprint laid out in Peter Lynch's classic book, Beating the Street. You probably know Lynch is one of the most successful mutual fund managers in history, but his biggest message? It isn't about complex math. It's that everyday amateur investors have a massive, undeniable edge over the Wall Street pros.
Okay, Chapter 1, The Miracle of St. Agnes. Let's get right into it. So, picture this. The year is 1990. Joan Morrissey, a teacher at the St. Agnes Parochial School, has her 7th graders put together a model stock portfolio. Just look at the actual scorecard of their picks here: Walmart, Nike, The Gap, PepsiCo. Over the course of 1990 and 1991, their portfolio produced that massive 69.6% return. I mean, in the process, these kids outperformed 99% of all highly paid equity mutual funds. Let that sink in. The adults, armed with MBAs and all those expensive computer systems, got completely trounced by 7th graders relying on a scrapbook.
Which brings us to Chapter 2, Amateurs versus the Suits.
Why on earth did the amateurs crush the suits? Well, it all comes down to structural disadvantages. As an amateur, you are totally free. You can choose literally any stock you want. And hey, if you don't see anything you like, you can just sit in cash and wait for the perfect pitch. But the pros? They are highly restricted. Many mutual funds actually aren't allowed to put more than 5% of their assets into a single stock. And worse, they are heavily pressured to buy approved companies. Like IBM. Because if IBM tanks, nobody gets fired. But if a fund manager takes a risk on a brilliant unknown company and it fails, boom, their career is over.
The absolute crux of this is captured perfectly in this quote from Lynch. Everyday investors don't suffer the career-ending pressure of lagging the market for a single quarter. The suits, they have to explain their short-term performance to angry clients every 90 days. You don't. That freedom to think long-term is basically your ultimate superpower.
Moving on to Chapter 3, The Stock Market Reality Check.
Before we reveal the exact method those kids used, we really have to settle the oldest debate in personal finance: stocks versus bonds. Now look at this table. From the 1920s all the way through the 1980s, in almost every single decade, the S&P 500 utterly dominates long-term government bonds. Out of 7 decades, bonds only held a slight advantage in exactly one, the 1930s. So sticking with stocks all the time? That basically gives you 6-to-1 odds right in your favor.
And that leads perfectly into Peter's principle number 2, gentlemen who prefer bonds don't know what they're missing. Lynch makes this crystal clear. As companies grow, their profits increase, and their dividends go up. Sitting on the sidelines in bonds while corporate dividends rise, that is a guaranteed way to miss out on building serious, multi-generational wealth. You simply have to own shares in the growth of the economy.
Okay, I want you to pause for just a second. Drop a comment below right now answering this question. What is a product or service that you use every single day that you've actually thought about buying stock in? Seriously, let me know down in the comments, because your answer perfectly sets up the exact strategy our St. Agnes 7th graders used to dominate Wall Street.
Chapter 4, The Crayon Rule.
Let's look at the actual methodology these kids used to pull off that massive return. They inadvertently applied Peter's principle number 3. Never invest in any idea you can't illustrate with a crayon. I love this. It's the ultimate amateur weapon. So many adult investors ignore totally understandable businesses in favor of overly complex, incomprehensible tech trends that just end up losing money. Basically, if you can't draw a picture of how a company makes money, you probably shouldn't buy it.
And just look at how the kids applied this. The St. Agnes winning picks included Pentec. Why? Because it was the exact brand of highlighters and markers they were physically using on their desks. They picked Topps because they traded their baseball cards in the schoolyard. They bought Nike and The Gap because, well, that's what every kid was wearing. They simply observed their daily lives, bought what made sense, and completely walloped the adults.
All right, Chapter 5,
Silencing the weekend warrior.
Now, you might know how to use the crayon rule perfectly, but honestly, it means absolutely nothing if you fall victim to panic. Over a 70-year period of market history, there were 40 terrifying market declines. Think about that, 40! And 13 of those were massive drops of 33% or more. The takeaway here? Scary market crashes are completely normal, recurring events. They are literally as predictable as winter snowstorms in Minnesota.
The financial media is always going to sell you doomsday scenarios. They're going to tell you the world is ending every single weekend. But as Peter Lynch says, it isn't the head but the stomach that determines the fate of the stock picker. True wealth is built by having the iron stomach to hold on to great companies when everyone else is running for the exits in an absolute panic.
So, to summarize your edge over Wall Street, you do not need a finance degree. You just need to stick to what you know using the crayon rule. You need to leverage your absolute freedom from the professional constraints that tie up mutual fund managers. And most importantly, you have to ignore the weekend warriors, tune out the doomsayers, and just let the long-term magic of the stock market work for you. I'm going to leave you with this provocative question. Are you ready to draw your own financial future, or are you going to keep letting the suits hold the crayons? Think about it. If you want to keep building your edge, check out the related explainer right here on screen for more incredible wealth-building strategies. And please, hit that like button and subscribe if you found this breakdown valuable. See you in the next one.